share my screen. Mike, can you see your PowerPoint?
Yeah, we're good. Thanks, Tom.
So, today we're going to start the lecture on the Federal Reserve and the conduct of monetary policy and interest rates with a guest. And this is my friend Mike Schumacher up there. You may recognize his voice, his face, if you see him on CNBC, where he sort of advises our important clients at Wells Fargo on, what the Fed is up to, where interest rates are likely to go, what are some of the pain points in the interest rate and bond markets. And so, what better way to start this part of the semester than with someone who advises really important clients and people who and clients who want to listen to what Mike has to say. So, Mike, I see your presentation. You'll tell me when to progress it, and over to you.
Sounds good. Thanks, Tom. Thanks for the intro, and thanks to all the students there for attending. I appreciate it, and hopefully it's a very engaging and interesting session. And by all means, if you have questions, fire away. So let Dr. Kushner know. He'll relay to me or just blurt it out. I'll probably hear it, and we can take it from there. So I think we'll set the stage by talking about the bond market and really just how unusual yields and market levels have been for quite some time. And it relates to COVID. So we're going to slide number 2, and you can see it on the screen. So the first point to make is that bond yields are incredibly low. Yes, they've come up off the bottoms that they reached last year, but these are still remarkably low levels. It's true in the US, it's true in Japan, it's true in Germany, as you can see on this chart. In fact, some yields are negative, which is really quite a strange concept, but yields are just super low. And the reason for that is this intersection of COVID, government spending, and monetary policy, which is what the central banks do. And it's all come together to really create a very potent combination. But the takeaway is that yields are incredibly low for investors of all types. It's been very difficult to try to pick up return. And we think low yields are likely to be a fact of life for quite some time. So our view at Wells Fargo is that yields in the US probably go up a little bit by the end of the year, but still we're likely to have long-term rates that are well below 2%. Now, some of the implications for potentially you or perhaps your siblings or parents or whatnot, our mortgage rates also are very low. So anything anchored to a treasury yield in the US, which is really, I'd say, the fundamental rate for borrowing, it's been a time of very cheap money. So if you've been able to access borrowing, it's been a pretty good deal. For global investors, a lot tougher. So Tom, let's go over to page number 3 now. So one question we get all the time is, do bond yields track economic fundamentals? And I would love to be able to tell you that they do. Unfortunately, they don't. And they haven't really for quite some time. So your instructor, Dr. Kushner, and I have been in the markets for a while. And really, I would say that this decorrelation goes back to 2008 and 2009, what's called the global financial crisis. And what happened at that point is central banks got very, very involved in markets, and they haven't really exited. They scaled back a little bit in 2018 and 19, but by and large have been huge players. And we think that really broke or at least severely weakened the link between things like inflation or growth or unemployment and bond yields. And in this particular chart, we're looking at German yields. So the blue line is the 10-year German Bund yield. And as I noted on the previous slide, it's very low. It's actually negative right now, which is a strange concept again, and I'll talk about that in a minute. And against that, you've got inflation, which we measure here by core CPI, so the Consumer Price Index. And if you look at that gray line, that's the European Central Bank's bond holdings, and you can see it's gone straight up. So if you look closely, I would say it tracks pretty well. Once the ECB or the European Central Bank became more active, that relationship between bond yields and inflation just disappeared. And you'd say, well, that really does seem strange because inflation eats away at the purchasing power you've got in a bond. So wouldn't it really be a key factor driving rates? And again, historically it has been, but not so much in the last 12 years or so. We can move on to the next slide, please, Tom. Now, when you think about adjusting for expected inflation, Then we get to a concept called a real yield. And I've had a number of conversations with clients recently, and the question is along these lines. They'll say, well, I know what a real yield is mathematically, but what is it economically? And to me, it's really the expected economic return for holding a bond to maturity. And what you find right now is in US treasuries, let's say the 10-year treasury, that real yield is about negative 1%. So it's a very odd idea. You'd say, okay, I buy a treasury note, hold it for 10 years, and after inflation, if inflation is what I expect it to be, I actually have less purchasing power than I did on day one. So why would anybody do that? You'd have to be super risk averse, or maybe as a professional investor, you might try to be really tactical. But I'd say for your typical investor, for one of you, for people you know, for what the industry broadly calls retail investors, and it's not an insult, we're all retail investors, I am, Tom is as well. The idea of holding a long-term bond and actually holding it for a very lengthy period of time is not very attractive right now. So when you look at these real yields, again, negative in the US, negative in Germany, negative in Japan, negative in the UK, you see a pattern here. Very, very deeply negative yields across the board. And this is one way to measure just how easy central bank policy is. The objective, or really I'd say the label people attach to easy central bank policy, generally speaking, is yields are very, very low. Well, really what you should care about is how low are yields relative to expected inflation. And in this case, they're about as low as they've ever been. And you can see that in this chart going back 20 plus years. This is really unprecedented. The US had one other period of negative rates, which was back in 2012 and 13. Didn't last very long, maybe 8-9 months, something like that. This time around, it's been much more lengthy, and I suspect it continues quite a while. So I noted a couple of minutes ago that our forecast at Wells Fargo is what I would call nominal yields go up a bit by the end of the year. But in terms of adjusting for expected inflation, we think these real yields are going to be negative for quite a while. So a very different set of circumstances. And again, it all goes back to central bank policy. So let's go to the next slide, please, Tom. Now, I noted at the outset that really this is an intersection of COVID, huge fiscal stimulus by governments globally, and monetary policy. So let's talk about the fiscal side of things. What happened last year? COVID kicked in, it was terrible. I'm sure it was awful for you, probably for really everyone you know. It's been challenging for all of us. And the US government responded very quickly. It had an enormous spending bill early last year, back last April, and that was about $1.8 trillion. And it's had a number of spending bills since then. So what happened is the government said, we have a crisis. We have to spend a lot of money. We have to help people out. We need to increase unemployment benefits and do all sorts of things. And as you can see in the chart, this meant that the US deficit, the budget deficit, was enormous, the biggest it had been since World War II. And you can see here on the chart, it was about 19% of US GDP last year. Now this year, it's going to be a lot smaller, almost for certain. It's something on the order of 11, 12%. And next year, we think it's quite a bit smaller still. But the bottom line is the US spent a lot of money, spent a lot of money it didn't have. So it had to borrow to pay for that. Let's go to the next slide, please. But here's the thing. COVID didn't happen in isolation. As you know, it's a pandemic. That means global. So if you look at country after country, governmental spending was huge. These numbers come from the International Monetary Fund. So focus on 2020 and 2021. We can talk about next year if you like, but you can see these numbers are deeply negative for, again, country after country. The US actually was the biggest spender, has been. The UK was a pretty close second. Even a country like Germany, which normally is very resistant to deficit spending, has gone 5-6% of GDP in the whole this year. Pretty unusual. Canada, you can see, is about 8%. Australia is about 10. These are big, big numbers, and they don't come back quickly. So it's not just the US, it's pretty much every country is spending a lot and therefore borrowing a lot. So it's been a simultaneous global event, not only with respect to COVID, but also in the financial markets. Let's go to the next slide, please. What that translates to is a lot of issuance of government bonds everywhere, whether it's in the US issuing treasuries, Germany boons, the UK gilts, country after country. But a very interesting thing has happened. The central bank said, well, we want yields to be low because we want to stimulate the economy because things could be so bad during this COVID period. We're not really sure just how to get out without having super low rates. And at the same time, our governments are issuing a lot of debt. So what do we, the central bankers, do? We buy a lot of it. And that's exactly what happened in the US and quite a few other countries. So if you look at this chart, what we're comparing here is the change in US Treasuries outstanding. That's the series of blue bars, which you can see last year, 2020, increased by more than $4 trillion. Just a massive number, hard to really to fathom. And against that, we've got something called SOMA. So what is SOMA? SOMA is a system open market account. It's the Federal Reserve's account. It's where it holds securities. It's like a massive brokerage account, but for the Federal Reserve. And you can see that the Treasury holdings at the Fed's SOMA increased by more than 2 trillion last year. So in round numbers, the Fed absorbed about half of the Treasury bonds that were issued in 2020. And you can see in this year, 2021, it's even a higher ratio. It's probably more like 2/3. So the Federal Reserve has been taking out a lot of that supply, and that's true in other markets as well. The European Central Bank's been an enormous buyer of bonds. Japanese central bank as well has been buying a tremendous amount of bonds. The Bank of England, you get the idea. So this has been a very common tactic, and all the idea behind it is to keep interest rates very low. So governments issue a lot of debt to pay for COVID programs. Central banks help out by buying it. Let's go to the next slide, please. So let's talk about monetary policy in a bit more detail. So what do we have here? Well, generally speaking, what central banks are told to do is control inflation. And there are some variations around that theme. So if you think about the Federal Reserve, it's got a dual mandate. So it's supposed to provide price stability and full employment, or at least aim for those things. Those are the goals. And these goals are set by Congress, and Congress can change them. It's added really a supervision quality to the Federal Reserve as well, and it's expanded that over the years, and it may well tweak these things down the road too. But generally speaking, if you hear about the Federal Reserve, if you're reading a newspaper, the Wall Street Journal, or you're listening to CNBC or Bloomberg or some other business show, and they talk about the Fed's mandate, that's what they mean. They mean price stability and full employment. So when you think about some of these measures, how would you measure price stability? Well, you'd focus on inflation. And there are lots of inflation measures. In this particular chart, we happen to graph the CPI, which is the blue line. And you can see it's quite high. It's actually gone up more than 5% over the past 12 months. And I would venture to say that you can probably see this in your daily life. If you go to a Starbucks or something, I would imagine it's more expensive than it was a year ago. Certainly if you get an Uber, it's very costly. Lots of other examples too. So inflation is not just an abstraction, it actually counts, it hits in the wallet, hits in the pocketbook. So bottom line here is inflation is quite high. Generally speaking in the US, and if you look at the decade prior to COVID, so let's focus on 2010 to 2019, CPI averaged about a 1.7, 1.8 increase per year, something like that, less than 2%. And again, for the last 12 months, it's above 5. So very high inflation. And at the same time, we've got unemployment that's quite high. You can see it's above 5%. That's the orange line. Now, the good news is unemployment has come down dramatically, and that's partly a function of all the governmental programs we talked about. So a lot of that spending was motivated to get people back to work and also to pay additional unemployment benefits until they could find work. And that seems to be working. But still, you've got a situation, if you're sitting at the Federal Reserve, you look at it and say, well, our mandate is price stability and full employment. We've got a lot of people unemployed, so we're not doing so well on the employment mandate, and we still have really high inflation. How do we reconcile those things? What do we do? Well, the Fed's take on this is that these things in terms of high unemployment and high inflation are going to be transitory. That's the term it's been using time and time again for probably the last 8 to 9 months. And I think to a degree, these are short-lived, but the question becomes how quickly do they revert to more normal levels? And ultimately, what's that equilibrium? So if we think about inflation in a year or two, is it going to reside at the same sort of level that was viewed as normal back in 2018 or 19? Frankly, I doubt it. And a lot of my colleagues doubt it. If you talk to our economics team at Wells Fargo, they'll tell you inflation is very likely to be higher going forward than it had been previously. One big reason for that is supply chain changes. You've had things like iPhones, for instance, being largely manufactured in China, or other manufacturers relying on very distant suppliers. And I think for a lot of the people running those companies, the CEOs and CFOs, they look at it and say, well, you know what? Pre-COVID, we were pretty confident we could get all these supplies quickly. We didn't have to worry so much about idling workers for a few months because we were short. That was okay. But things have changed. It's become more difficult to source this stuff. So probably what we should do is move some of those manufacturing capabilities closer to home, or some of those raw materials, try to get them a little closer to us, or in a country that we regard as a little more consistently friendly. So as that happens, we think that's inflationary. So it's not to say that inflation goes up from today's level, but it probably winds up being at a higher level equilibrium than it was a couple of years ago. So let's go to the next slide, please, Tom. Now, another thing you hear about when you listen to commentary about the Federal Reserve or about any central bank is, in addition to the mandate, people will talk about the reaction function. And this is sort of I wouldn't say it's an odd concept, but I think it's a little bit more cumbersome than it needs to be. Really, all this means is if the Fed is confronted with a particular set of circumstances in terms of unemployment, inflation, government spending, what is it likely to do? How is it likely to change its policy rates? And the Fed actually introduced a very modified, a very different reaction function about a year ago. The gist of it is it's telling us in the market and telling you, the voters, the people, that it intends to keep the Fed funds rate low for a very long time. So this is a new thing, and I've got a little video issue here, so let me deal with that. But really the takeaway is that we think that's going to keep, when you focus on this, it's going to keep the Fed funds rate low for a very long time. So this is a new program. No one is entirely sure exactly how it's going to work, but we do think that it's going to revolve around the Fed taking a somewhat different approach. So it's something to watch, something to keep an eye on. It's not battle tested. And I think this is one of the key questions confronting people in the markets is, will the Fed really stand pat if inflation stays a bit higher than it expects? We don't know, we're skeptical. You can see the Fed's forecast. The Fed updates these every quarter. It's going to put out a new set of forecasts on Wednesday of this week. And if you look at the unemployment rate that it forecasts for 2023, it's 3.5%. That's a great number. That would be the lowest number in 50 years. Can the US actually hit that? I'm a little skeptical. At the same time, core PCE, that's yet one more inflation measure. There are countless inflation measures. Keeps a lot of economists very fully employed, trust me. And the Fed is projecting just over 2%. So that's really I'd call it a Goldilocks combination. If you can have super low unemployment and quite low inflation as well, will the Fed get there? We're not so confident that it will, but we want to see how this progresses. Let's go to the next slide, please, Tom. So with respect to inflation staying higher equilibrium-wise than it had been previously, I already talked about this, but you can see the data country by country. This is really just an historical comparison, so we can skip over this. We'll go to the next one. Now, one thing that I've been finding very interesting is that when you consider the economic data that come out really every month in just about every major country, they've been almost impossible to forecast. The monthly forecasts have not been worth very much at all. And I'm not taking a dig at economists, simply saying there have been so many really unusual variables out there with COVID, all the spending, the incredible monetary policy shifts. It really makes trying to get a view on something that updates every month very, very challenging. So I suspect it's a case where the long-term forecast is a lot more confident than the short-term forecast. And one easy way to measure this, I don't know if you've ever seen or heard of a Bloomberg terminal, but Bloomberg does a lot of surveys for various types of economists looking at all sorts of data. And in particular, we're looking at this one. This is for the Consumer Price Index. And I just looked at the difference between the high and the low forecast for CPI, as you can see, going back a number of years. And if you look at the period pre-COVID, so let's say from in 2019 and the first couple months of 2020, you can see the range of forecasts is around 0.2, so 0.2%. More recently, it's consistently been 0.4, in some months 0.5, 0.6, higher. So the forecasters have been having a difficult time. But if you look closely at the chart, you can see they appear to be becoming more confident. So the range is narrowing. This is a good thing. This is a natural thing. Our expectation is over the next, probably call it 2 to 3 months, we think there's going to be a lot more clarity in the economic data. And these things should be easier still to forecast than they have been. Well, let's move on there, Tom. So this really just goes to show how much people have been revising their estimates of various types of things. This is inflation over the course of the year. It's been remarkable to see. So for instance, at the Federal Reserve, you can see it says FOMC dots median 2021. It's some kind of strange code under core PCE, but just look at the numbers. So back in December of 2020, the Fed forecast for calendar 2021, so taking a 12-month view at that point in time, inflation would be 1.8%. And now, at the end of this period, so actually, well, a few days ago, but these are the June estimates, the Fed's number was 3% for the year. So it raised it by more than a percentage point. This is the Federal Reserve. This is the central bank, the most powerful financial institution, I would say, in the world, and still was not really able to forecast inflation even in the same calendar year. Now, if you look at the forecast for next year, this gets to my comment that it's probably easier to forecast out a ways than it is near term. Look at that, really the bottom segment of the table, and focus on the FOMC dots median for 2022. In that case, you can see it's only, the forecast it is only gone up by 0.2. So the Fed is a lot more confident for next year than it is for this year. That's also true of my colleagues in Wells Fargo Economics. You can see they've raised their number for 2021 substantially. And if you look at the headline CPI, more than 2%, and not nearly as much for next year, about 1%. So big revisions going on as people try to cope with all these shifts. So the point to you is that if the order of business for the Federal Reserve is to conduct monetary policy, and one key component of that is forecasting inflation, this has been an incredibly tough year because the inflation forecasts simply haven't been very good. It's been too tough to handicap them. So let's move on to the next slide, please. So we're coming up probably on something called tapering. So we showed that slide a few minutes ago in which Treasury issuance was very large, and the Fed bought about half of that last year and about 2/3 this year. Well, the idea of reducing bond purchases is called tapering in the market. And really just about every client we talk to, and Tom and I talked to quite a few, has an opinion on tapering. Is the Fed going to taper at the upcoming meeting, so on Wednesday? Very unlikely. Is it going to taper in November? Maybe, but that seems a bit complicated. How about December? That's a lot more likely. That's our call. But my point here is that the Fed has a number of governors and also it has regional Fed bank presidents, and they all have different opinions too. So when we think about commentary coming out of the Federal Reserve or really any central bank, we focus on the 2 or 3 most senior people, just like you would for a corporation. If the CEO says something, if the CFO says something, chief operating officer, you pay a lot of attention. If it's someone else, probably not as much. So with the Fed, what that means is we pay a lot of attention to Chairman Powell. That's Jay Powell, whose term is up pretty soon. We pay a fair amount of attention to the Vice Chair, Richard Clarida, and the others don't get quite as much attention. They tend to move markets, but not as much as what I would call the big 2. And generally speaking, when you think about the comments we've had from the big 2 in the last few months, they seem to favor tapering, but toward the end of the year, not sooner. They've been pretty non-specific, but that's my takeaway. We can advance to the next slide, please, Tom. This is just more of the same, more of these comments from regional presidents. You can look at them if you like, but it really just goes to highlight the different viewpoints out there. We'll go to one more slide. So we've talked about differences of inflation rates, unemployment rates, interest rates across various countries. What you can see here is the market is pricing different activity by the central banks. So we don't need to focus too much on the particulars of the chart. All I'd like you to focus on is the spread between the high and the low number currently. So it's RBNZ versus ECB. And you can see it's about 160. Those are basis points. It means 1.6%. That's the difference today. Now let's go back to the beginning of the year. It was probably 40 to 50. So there's a much bigger spread in the policies of these central banks now than there had been 9 months ago. And that tells us it's really indicative of the central banks being on different paths. Some are pretty likely to raise their policy rates very soon. Others we think could wait next year. Others still, like the Fed, probably wait beyond that. So whereas 9-10 months ago, when we were deep in the throes of COVID, when vaccines were really just being introduced in a lot of countries, everybody is really following the same playbook. But now circumstances differ to a fair degree across countries. You got some huge inflation rates in some and some more diminished rates in others. The central banks are acting accordingly. So this has been a pretty notable shift in the last few months. And I think I'll wrap it up there. We can talk about, if you like, other issues that are up in the market, whether it's related to bond yield, central bank policy, what have you. So if you have time, I could take a few questions. Otherwise, we can move along to the next topic in your lecture.
What questions do people have for Mike? And are you raising your hand, Paul, or?
No, sorry.
Sorry. I'll start, Mike, because we're going to be looking at central bank policy. We're going to be looking at the Fed very closely for the remainder of the class. And you said you used some terms that people in the markets would understand, and maybe you could clarify when you say that a central bank is conducting easy policy. Can you just explain to the students what exactly you mean by that?
Sure. Yeah, central banks, broadly speaking, have policy that's either becoming easier or tighter. And historically, what they would do is when they wanted policy to be easy, they would lower their target policy rate. So in the US, it's called the federal funds rate. Now, the problem is right now that's just about zero. So in addition to lowering the federal funds rate, the central banks came up with this other idea, which is to buy bonds. And that's called quantitative easing. So the charts we showed with the Federal Reserve absorbing a good portion of Treasury issuance, that's quantitative easing really maxed out. And if you want to boil it down, you can say, well, why do you really want to drive rates down? You make borrowing costs much lower, which helps the economy recover. And also on the investment side, one thing we heard a lot about when central banks first started doing this quantitative easing is they wanted to make things like government bonds so unattractive, investors would be compelled to buy something else, high yield bonds or equities. So really to drive all parts of the economy to make capital cheaper for corporations and keep funding much more attractive for people borrowing money for a home mortgage, or for a commercial property or anything like that. So that's what easing means. Tightening is really the opposite of that. So if a central bank, generally speaking, if it sees inflation running fairly high, so the Fed's target is about 2%. So let's just say in a year's time, inflation doesn't go down as low as the Fed thinks, and it's sitting there at 3. What does the Fed do about it? It says, this is no good. We're missing half of our mandate. We have to try and combat that. And the way we do that is we raise the Fed funds rate. So the Fed might raise the funds rate to 1% or 1.5% or something like that, and then see how inflation adjusts. And it takes a while. There's a lag in monetary policy. All sorts of academics debate how long that is. I'd say it's probably 9 to 12 months, maybe more. But generally speaking, when a central bank wants to tighten, it'll raise that policy rate. When it wants to ease and help the economy recover, it will either lower the policy rate or it'll buy bonds.
Great. Thanks, Mike. Question. Anybody else? Anything on your mind to ask Mike? Isabel.
I have a question. I was just wondering, what your opinion on why, I know you talked a little bit about it, but why the unemployment rate is still so low. Obviously, things are starting to get better with COVID, and then the Delta variant came back out. So kind of your opinion on why it's still low, and what needs to happen for it to get better within the next couple years.
Yeah, the unemployment thing has been really challenging, and the unemployment rate has come down quite a bit. It's higher than historical standards and certainly higher than probably anybody in the US would like. And one stat that Jay Powell, the Fed chair, cites quite a bit is if you compare the number of people employed today to the number employed just before COVID. So let's say in February of last year, it's a deficit of about 5 million jobs. So how do you bring those people back into good paying jobs? And I think a few things have to happen. Number one is get rid of some of these supply chain issues. Because if you run a manufacturing company and you're not confident you can get your supplies on time, you don't need as many workers. So that's a challenge. Second thing is make people more comfortable with the outlook for the disease. So maybe they've had a couple shots, they're vaccinated, and they still say, you know what, I've heard about these breakthrough cases, they're dangerous, Delta seems pretty challenging. Am I really comfortable if I have to work in a pretty close space? Do I want to do that versus maybe sit it out a couple more months. So that probably has to happen as well. So it's a matter of time, I think, for those things to occur. And it'll happen, I believe, where you'll see that jobs deficit come down. It's been pretty choppy. It was very good progress for a while. The last 3 or 4 months have been quite a bit slower. But I would imagine you'll see that number fall by a couple million over that deficit, that is, over the next, call it 4 to 5 months. Still would leave us short, but it's going to take some time to get it done.
Thank you.
Anthony.
Do you think the current Evergrande debt defaults are going to have any supply chain disruption in China and affect the global markets?
The Evergrande situation had a big effect on markets today. I imagine you saw equities were down quite a bit. So at one point, it was the biggest drop in the S&P this year. I think it closed a bit higher than that. So it was still a pretty nasty day. And the question is really a couple different dimensions, I think. One is, if Evergrande defaults, which is almost inevitable this week, how does the bond market react? Probably not so well. My guess is that people look at securities issued by not just Evergrande, but its compatriots in China and say, I'm not so confident that the bond indentures or the usual credit protections that I might get in the US or the UK are valid there. So I'll require a cheaper price to buy those bonds. So it means funding levels become more expensive for those companies. And I think probably the bigger issue for global markets and maybe for the global economy is, does China really push hard at retooling certain parts of its economic situation? So what I'm getting at here is there's been a lot of commentary over the last couple of years about China having this enormous boom in commercial property. You may have heard about ghost cities, et cetera. And sooner or later, there would be a bill to pay, a price to pay for that. Is that price happening now? Does the Chinese government, is it super concerned about that? Does it care a lot? Global markets, I think, have really been very fixated on the level of GDP production, GDP growth out of China. And if that fades a bit, that causes a lot of concern. So it's a long answer. At this point, it's too soon to tell, but I think you're going to see some volatility continue for a while from that.
Great. Ben.
Yeah, I was going to ask, when tapering happens, how does it affect the markets? So I imagine it causes like some sort of panic.
Yeah, it's a great question. And client after client has an opinion, not just on when tapering happens, but what the impact is. Some people say tapering is about the most advertised change in policy ever. Therefore, it should be fully priced in or pretty close to it and won't have much effect. We think something a little bit different. We think a lot of it may be priced. So the taper effect will be much less dramatic than it was in 2013 when the Fed tried it and didn't go so well. But we still think you're going to see a hit with interest rates going up a bit, and equities may be suffering somewhat. So big difference of views out there. We think it'll be a moderate impact, but higher rates and somewhat softer equities. That's our recipe.
Great. Mike, thank you very much. I'll just do a quick reaction to your presentation. The thumbs up sign, you should see that. So thank you for taking time with my class today. I know that it will really make my lecture a lot more robust for my students, and look forward to seeing you in person again very soon.
Likewise, my pleasure, and enjoy the rest of the session. Bye now.
Thank you.
Thank you.
Thank you.
Thank you.